When facing financial hardship, your retirement savings might seem like a tempting source of relief. A 401k hardship withdrawal allows access to retirement funds for urgent financial needs, but comes with significant consequences. Understanding the rules, alternatives, and long-term impacts is crucial before making this decision. A 401k hardship withdrawal is permitted by the Internal Revenue Service only for immediate and heavy financial needs. Not all retirement plans offer this option, as employers aren't required to include it. According to IRS guidelines, qualifying hardships include unreimbursed medical expenses, housing needs like preventing eviction or foreclosure, college tuition payments, and certain other necessary expenses. Before considering a hardship withdrawal, you must have exhausted all other distribution options available in your retirement plan. After taking a hardship withdrawal, you typically cannot contribute to your 401k for 6 months, though recent legislation has modified some of these restrictions. Recent changes through the Secure 2.0 Act have made accessing retirement funds for hardships somewhat easier. The new provisions allow withdrawals for emergency personal expenses without mandatory contribution suspensions. Plan sponsors now have more flexibility in defining what constitutes a hardship situation. Check with your plan administrator to see if your employer has adopted these updated provisions. It's important to note that hardship withdrawal rules only apply while you're still employed by the sponsor of your 401k plan. Once you leave that employer, different distribution rules apply. Taking a hardship withdrawal offers some benefits but comes with significant drawbacks. On the positive side, you gain immediate access to funds during an emergency without needing credit approval, and there's no obligation to repay the money. However, the negatives are substantial. You'll face income tax on the withdrawal amount, plus a 10% early withdrawal penalty if you're under 59.5 years old. You'll lose potential investment growth on those funds, and your retirement savings will be permanently reduced. To qualify for a hardship withdrawal, you must prove your financial need. Employers may require documentation, such as medical bills, eviction notices, tuition invoices, or proof of funeral expenses for a dependent. Some plans allow self-certification, where you simply attest to the hardship without detailed documentation, though requirements vary by employer. Before taking a hardship withdrawal, consider a 401k loan instead. Unlike withdrawals, loans aren't taxed as income and avoid the 10% penalty. You repay the borrowed amount to your own retirement account, preserving your savings. The interest you pay goes back into your account rather than to a lender. However, if you leave your job before repaying the loan, the remaining balance may become due immediately or be treated as an early withdrawal. The tax implications of hardship withdrawals are significant. The withdrawn amount is added to your taxable income for the year, potentially pushing you into a higher tax bracket. If the withdrawal comes from Roth contributions, you may avoid income tax on that portion, though employer contributions will still be taxed. Beyond immediate tax consequences, hardship withdrawals have long-term effects on your retirement. Withdrawn funds lose the benefit of compound growth over time. A $10,000 withdrawal at age 40 could mean missing out on more than $50,000 at retirement, assuming average market returns. Additionally, the 6-month contribution suspension means missing potential employer matching contributions. Before resorting to a hardship withdrawal, explore other financial resources. Consider using emergency savings, a home equity line of credit, or personal loans. Nonprofit credit counseling services can help manage debt without depleting retirement savings. Government assistance programs like Medicaid, unemployment benefits, or food assistance might provide temporary relief without long-term financial repercussions. Remember that creditors cannot access your 401k funds, and these accounts are protected in bankruptcy. If you're considering bankruptcy, it's generally advisable to leave retirement funds untouched. A 401k hardship withdrawal should be your last resort in a financial emergency. The combination of taxes, penalties, and lost retirement growth makes this an expensive solution. While it can provide immediate relief in truly desperate situations, the long-term cost to your financial future is substantial. Carefully weigh all alternatives and consult with a financial advisor before making this significant decision.